Many active traders lose money on most trades. The difference between portfolios that survive and those that get swept away is unmanaged risk. The primary tool for managing that risk is the risk-return ratio. By strictly defining this metric, you place an absolute cap on exactly how much capital you can lose on any single position. In this guide, we will build a risk-managed trade from scratch. We'll calculate the exact mathematical ratio of the position, an automated order to enforce your protection. To follow along, you only need an active brokerage account and a target stock to trade. Relying on emotional guesses during market hours leads to panicked selling. Locking in a calculated, mathematical framework before you buy is how you survive long-term market volatility. Before putting a single dollar on the line, you need to establish two firm numbers, a concrete entry price and a projected target price where you plan to take profits. This chart shows a hypothetical trade setup for XYZ company. We will set our entry line here at $20 per share and our target profit up at $30. If the stock hits our target, we make a gross gain of $10 per share. Calculating your potential upside is only half the equation. A trade plan is critically flawed until you explicitly define your exit floor. This exit floor is your bailout line. It is the exact price point where you accept your original thesis was wrong, allowing you to exit the position before taking heavy damage. On our XYZ chart, we set a bailout line at $15, establishing a maximum acceptable loss of $5. The risk-return ratio formula is potential loss divided by potential gain. Dividing our $5 risk by our $10 reward gives 0.5, or a 1-to-2 ratio. In investing, a lower ratio indicates a more favorable balance. For example, a 1-to-3 ratio, meaning 1 unit of risk for every 3 units of expected return, is a highly favored benchmark for market strategists. Securing a mathematically sound ratio ensures that your occasional winning trades outpace the financial drag of your inevitable losing trades. A conservative investor can adjust this ratio. By moving the stop loss closer to the initial entry price, you minimize your total dollar exposure. If we adjust our XYZ stop loss and move it up to $18, our risk drops to $2 while we maintain our $10 target. We now have a highly favorable 1-to-5 ratio. Warning tone, but tightening the floor introduces a secondary danger. With the stop order now much closer to the entry point, you drastically increase the chances that normal market fluctuations will trigger a premature sell-off. You have to balance an aggressively optimized risk ratio against a realistic probability that the trade can actually succeed without being bumped out by daily volatility. Calculating the perfect ratio on paper is completely useless if you rely on manual, emotional reactions to execute it during market hours. Inside your brokerage account, instead of placing a standard market order to sell, you will select a stop-loss order. Simply input the exact calculated stop price you mapped out earlier and finalize the order. Automating your downside exit removes human hesitation from the equation. It permanently hardwires your mathematical advantage directly into the portfolio. Step 1 is complete. You have a defined entry, a strict profit target, and a capped downside. Active investments are dynamic. As a stock's price rises toward your target, the potential reward becomes smaller and the potential risk increases. Your initial ratio becomes outdated. This chart shows a trailing stop loss. As the price action climbs, you manually adjust the order upward to protect your newly acquired profits and maintain your target ratio. Establish a routine for periodically auditing your open orders. Verify that your active ratios are still aligned with your portfolio goals. The disciplined, repetitive application of this exact risk management template separates professional investing from blind gambling. Map the math, automate the exit, and execute the plan.